Good morning, everyone. Welcome to the Hedgeye Morning Macro Show. I'm Christian Drake. I'm joined in the studio this morning by Keith McCullough and our new sector head of demography, Neil Howe.
The Fed has been trying to play this positive expectations game with the forward guidance, right? And pretty soon no one believed her anymore, right? And now they started mentioning NIRP, negative interest rate policy, and guess what? People are believing that. So this is the problem now. With the negative expectations, they are believing that, and that's what happened in Tokyo. So they suddenly came back from Davos, said, let's go negative, and then everyone said, oh my God, now this shows what they really expect.
Right.
So that's the only thing that explains it. Why would the stock market go down, the yen go up, right? There's only one thing that can explain it. Suddenly people have this disaster scenario of acute deflation, right? And an economic spiral. It may be a corner solution, it may be not the most probable thing, but suddenly it seems like a substantial possibility. And that's what's causing this.
And maybe, like, is it one, do you think, and I want to go through how you think that millennials might think about this, you know, as opposed to baby boomers, or if there's a difference at all?
There are two different aspects of it. You know, first of all, for equities, this tumble is great for them. I mean, they get to buy into the American dream at cheaper price. Yeah, millennials. Yeah. I mean, there's no problem. You know, if the S&P goes down by half, they get to buy into the American dream at half the price. Right? I mean, come on. No, but that's simple. They aren't invested yet.
Right.
So now as they go forward, if it stays down, I mean, just imagine a scenario, right, where it stays down for a while, they get to invest in the same plant and equipment, intellectual property, everything for half the price. So that's obviously a gamble for them. On the other side, it's interesting, you really have to look at fixed income, because what happens is, obviously with NIRP and ZIRP and QE and all that stuff, it causes asset prices on all this fixed income to go up and up and up and up, which is great for the elderly because they own all that stuff. Yeah. So for the boomers, the silent generation, which is sitting on all those annuity income, right, all that stuff, that's just going up in income for them. So they're still doing well with this current environment. And there is a commonly held belief that very low interest rates hurt the elderly. Actually, they don't, because most of the elderly, and if you look particularly at the average, you know, person over age 65 or over age 60, they're the ones that are the predominant owners. You know, 87% of all these fixed income assets are owned by them.
That's the number.
So that stuff is going up.
And probably a lot of the real estate too. I mean, which is a direct function of
which has the same dynamic. So a lot of the people that are simply, you know, trying to save in banks and so on at a very retail level, obviously the young, and millennials are interesting because they're not, you know, they think of real estate is risky, they think of equities are risky, they think of everything as risky. The only way you get millennials to invest in equities is to fool them by giving them a target date fund, and then they don't know they're investing it. You know what I mean? So it's all an algorithm, and then it's automatic, so it's okay, you know. But they don't have to choose an equity. Yeah. That frightens them.
Well, and David Einhorn's talked a lot about this. I think a lot of really thoughtful investors that I respect have talked about the income side of ZIRP, or which is now NIRP, for a young person. So if your cost of living has gone up here, if you live in San Francisco, you probably, if you make $50,000 or $60,000 out of college, you're probably spending $30,000 to just have an apartment. Yeah. You know, the income side, he kept saying that's the point, which is if you have zero, there's no way for people actually to accumulate any wealth or buying power, and they're taking it all on the cost side.
What's fascinating is millennials, despite the fact there's no reward, millennials are actually saving at higher rates than earlier generations did at the same age.
Really?
Oh yeah. Okay. I mean, Xers had profoundly negative savings rates in the 1990s when they were that age. Boomers, we all thought we were going to all have $1 zillion, right? So you know, people didn't save much in the 70s and 80s either. The yuppies. So typically, young people obviously just save when young. I mean, they have all kinds of other expenses to have. They're having kids and so on.
Yep.
But millennials actually, and I get this all the time from HR people I talk to. So who's showing up at the 401k planning sessions? People in their late 20s, early 30s. Not people in their late 30s, early 40s, mid 40s. Right. And it's these millennials show up. That's what are the benefits? I want more of them. What can I get? What can I stash away? Despite the fact they're not getting any return on it right now. And that just shows the overall risk aversion of this generation.